real estate investment group. Thanks for coming out tonight again. We have two great speakers tonight. Before they get started, we're going to talk 1 minute about membership in case there's any new people here. And then we'll give everybody an opportunity. We'll go around the tables and you introduce yourself, say who you are, what you do, and also if you have any deals that you're looking to get rid of or take on. Sometimes you guys get too many at one time. It seems when you put 10 offers on, they all get accepted at the same time, right? The 3, you were just looking for one that one. So I'm Kervin Horning. I'm a real estate agent at Kingsway Realty and an auctioneer with Mine Prayer and Good Auctioneers. I also do this little thing where I give a little market snapshot. I'll do that right now. Lancaster County Real Estate, we are about 0.1% behind year-to-date average sale price so far from last year this time. It is like flat. It is flat. And the thing that happened is from January, it actually dropped quite a bit, about $8,000 down into like June, July, and then it came right back up. It almost all made it up in June, July. So we're about right flat where we were last year. Number of transactions aren't changing much. Days on the market are down about 10 days from last year. It feels like maybe there's a little bit more activity, but things are good overall, I would say. As far as my commercial deals that we have coming up, I won't talk about all the auctions we have coming up, but we have 2 that may be of interest to this group. 154, I have seal bills laid up here. 154 Root Lane in Coatesville. It just needs a lot of work. I mean, it is a dump on the inside. So take a look at that. It doesn't look too bad on the outside, but not a lot of activity on that one. And then on Saturday, this Saturday, we have a really nice property on 3131 Compass Road. We have had 3 open house. Not a single person showed up at any of them. So I'm just saying, if you're looking for, now this would be more a place, 1.5 acre place, more for like set up for Amish. I mean, there's a little horse barn. It was built originally as like a retirement home for an older Amish couple years ago. It's not Amish owned right now, but there's if anybody knows of anybody looking for something down in that area to live at, this would be an ideal. This other one's an investment. We're going to start right here with Jonas. You can start introduction and any deals that you've got. Thank you.
My name's Jeremy Steiner. I'm a full-time real estate investor, flipping some properties, and also have a few rentals.
I'm Jay Feiner, also a full-time investor, landlord, and remapper. I'm anxious to see what we can learn tonight.
Eli King, full-time real estate investor. Right now we have a 3 unit for sale in Lancaster City, 21 New Dorward Street. It needs about $18,000 worth of work. Price is $69,900, although if someone offered me $67,500, I'd probably take it.
Dave from Gulf Construction. We built storage sheds. I'm also a real estate investor and I do real estate syndications, meaning we group 5, 6, 7 guys together and we pull down bigger deals than I could do by myself.
John Fisher, I'm in construction, I'm just here to run.
Sam's up in construction, part-time investor.
Amos Stokes Jr., shed builder, just here to learn.
Daniel Horning, woodworker, part-time investor.
Jesse Lance, I'm roofer, and the Sarah check is up. David Nance, part-time investor, shed builder, here to see what we can learn.
David Black, shed builder, learning, here to learn.
Ron Shepherd, Shepherd Real Estate in Shepherd County, is speaking tonight, so save that for him.
S&S plumbing, have a few apartments. Installers, also involved in plumbing, have a few rental properties.
Scott Rhodes, commercial real estate broker, 19 years in the business. Primarily I do development.
Emmanuel Stolzfus with Minnesota Realty and represent buyers and sellers.
J.D. Fisher with Minnesota Realty and Nickel One's Auctions here.
American construction worker, have a couple rental properties here.
Middle Lake, I'm a spray painter, and I see what I can learn tonight.
Dave Fisher, I do woodworking, here
if anybody is interested in becoming a member of the organization, you get 2 free times. You can come twice just to check it out, and then we charge $5 a month. And basically what it is, $60 a year, prorated to the end of the year. So if you sign up tonight, you've had your 2 free ones already, $24 to the end of the year. That'll cover your membership for the year. So thank you very much. I'll turn it over to Dave.
24 is not on the even 5. I don't know what it is,
Think
it
you-
would be 24.
If you can do that, count, auctioneers don't go like even numbers. All right. So it must be 25 or 20.
Or it is 20 dollars.
20. $20. Hey, I overcharged you. You believed it.
Good to see a couple new faces in the crowd tonight. This is a subject that's near and dear to my heart, and I look forward to this topic for a good few months. So, I was forced into real estate because I wanted to take part of that tax depreciation. Found myself in a situation after building a couple businesses where my tax liability was greater than my income had been a few years prior. And so after doing a lot of studying and learning and webinars and traveling and all that, I have a few answers, but I also I found a few answers to my problem, but also still have questions. So tonight I'm really looking forward to Ron Shepard and Kevin McClargan to teach us what they know on the subject, which I'm sure is vast. And we're going to have probably about, what do you guys budget, 30 minutes, 40 minutes?
We're going to do it together, just question and answer.
Okay.
So, see what everybody here wants, has questions on, wants to know. We can take off any questions to kind of get the information out there.
Good. Perfect. So there's going to be a long Q&A session tonight, so guys get ready as questions come up and they start answering questions. I'm sure it's going to lead into more questions and more answers, so get ready and write down your questions and feel free to holler them up to these guys. So with that, come on up. Ron Shepard is with Shepard Real Estate, and he's also a CPA, and he's involved in a few different ventures, which I'll let him explain if he cares to. Kevin McClargan is, I've known Kevin longer. He's done quite a bit of work for me over the years, and I've come to really trust his opinions, and I go to him for advice. So what I will tell you about real estate is this is a team sport, and while I could go online, get my LLC online and save a couple $100 and probably get some of my answers online, I choose to pay the guys that are really good at real estate, and they are part of my team. And this real estate thing is a team sport, and I would encourage you if you want to take your, you guys that are involved in maybe the single family home, and you want to get to the next level and start maybe doing it full time like some of these guys are, or part time or whatever, make sure you have good team members around you. So it's all yours.
You want to go first?
Go ahead, you go first, Ron.
All right. Yeah, Ron Shepard, I'm with Shepard Real Estate. I'm a full-time realtor, part-time CPA, used to be a full-time CPA. Owner of Shepard Real Estate, we have about 10 agents. Our focus is really on investment properties, whether it's flipping or rental properties. We do some small commercial properties as well. My background is, like I said, I've been accounting. I went to college and was trained as a CPA. I worked full-time for about 9 years. And since then I've had my own tax practice that I do part-time during tax season. So we mostly focus on, pretty much only focus at this point on real estate tax returns, either for partnerships, LLCs, a few S corporations for people who flip properties, and then individuals who have rental properties or related businesses. We don't do any construction or other businesses. That's more what Kevin handles. He handles a lot of real estate too. So he handles everything. I can only handle a very small portion of what you might have. My background in real estate goes that we're here for accounting and taxes, and kind of feel like we're dueling maybe tonight, the way they have it set up here. But Kevin and I are just here to answer questions, so we'll kind of take your questions and go off if we think there's things to expand on. We really want to hear what you guys have questions about with depreciation, like-kind exchanges, cost segregation, allocation, studies for assets. Kevin's going to talk about some of the changes to asset allocation, depreciation rules in the past year. We can get into some entity issues too if you have questions about that. But just here, happy to be here tonight, answer questions. One of the things I like to do is just help advise people on what would be a good investment for different people. And the great thing is, which I'm sure Dave can tell you through his phases, that what might be a good investment for one person here may not be a good investment for another person here. Some of that's going to be the type of investment, but some of it's also going to be due to the tax situation that the investor's in at the time. So what's a good investment for you right now might not be a good investment for you in 5 years or 10 years as your tax situation changes either. So just things to keep in mind when you're looking at properties. You're wondering, why did that guy buy that? There's no way, that's a terrible investment. I can't believe he bought that. Well, a lot of times there's other things going on with the tax situations or people's lives or whatever that they want to look at that help them to make those decisions other than just, what you might look at on paper as a good decision, or even something that's coming down the road that you might not know about.
Thanks, Ron. My name's Calvin McClargan. Some of you I recognize. Thanks for coming to listen for those who didn't. And Mike, if I put you to sleep, just let me know. I will. Okay, I want to talk about 3 things of real estate. First off, when you start out, I want to talk a little bit about settlement statements. I want to talk a little bit about when you first started out and now you've passed that stage, and you've got Tom Fanning happy and everybody else is happy with the settlement, the banker included in that. And then you move on to, okay, what are we going to depreciate? And that's where you look at taking your property, segregating it out as best you can, perhaps do a cost allocation study, asset allocation study, that is, with the cost, doing something like that, allocating out. If the benefit of that isn't as high as what the cost would be to prepare the study, you can sort of do your own judgmental things sometimes. I have not seen the IRS come back too hard on those kinds of things if they're reasonable, although they can deny it because if it's not certified, they can deny those kind of studies. So be careful how big you get with your allocations. I also want to talk about the biggest subject change in 2014, and that's the change of expenses versus capitalization. What can you expense now? What do you have to capitalize? What are the rules in regards to that? Lastly, if there's questions on what happens at the end of a real estate investment, that is when you're selling it, how is basis figured out, how is capital gain figured out, those are the kind of things that Ron and I can certainly help you with that process. Try to understand the tax side, if not the legal side as well. So just a quick touch on settlement statements. Anyone who's been involved in that process, make sure you have a good advisor through that process with a realtor, with an attorney, and get some help to make sure you understand what you're getting involved in. When it comes to the settlement statement, that's typically the IRS guideline to look and say, how do we allocate costs from this? Because, hey, here's your cost. Settlement statements will have important information that your tax preparer absolutely needs to have. So don't forget where you filed it. Please have it available when you go get your taxes done. You will need it. They will need it. It has the date. It has the address. It has what kind of property it is. It has the value. It has the settlement charges. And some of those settlement charges can be allocated to expense in the first year. Some of them can't. The tax preparer will know which is which. Some of that allocation can be done when you have to allocate out what's land, if there's land involved, and what's building, and what are land improvements. That's where a really good realtor like Ron can help you out with allocating out the lowest value to land. That's reasonable under IRS standards, because that's non-depreciable. You can't depreciate land. Or you can depreciate land improvements to a degree. Help you maybe with allocation of that cost and figuring that out based on standards. And then, of course, the building. And if you do a cost study on the building, if that makes sense, then you can allocate out to the different areas that the building may be comprised of, electrical components, heating components, or appliance components, and those kinds of things. Where asset studies really make sense is when you have some of the units that Dave might get involved with. Certainly, as I know Dave, his involvement with multi-unit buildings, where they have 3 or 4 of the same units, but there's 60 of them. That's where you're only doing an asset study on 3 or 4 of the units, and you multiply it by the numbers that are there, and those are really effective costs compared to the benefit that you get for allocating those depreciation numbers. But when you have a duplex or a single unit, that may not make sense. And again, I say you can probably stretch a little bit, allocate that yourself if it's reasonable. IRS, however, understood if it was under audit, they may deny that, and because it wasn't certified, even if it was done by you, you're not an expert. Any questions on that so far? Settlement process. Land is something that a realtor can help you get. You can also go to the county website, look at the assessed value, and take a percentage of that assessed value of the land that shows up as a ratio to the settlement statement charges and come up with a land value that way. That may or may not be in your favor to do that, but it certainly is acceptable to the IRS to do that method. Again, checking with your realtor is a good idea to run that number past them if that makes sense. 20 to 25% a lot of times in most places is a rule of thumb for what land value may be of a property settlement. But that all depends on how much land there is and where it's at and all that good stuff. Accounting, real quickly. Keep good accounting records. This is what determines whether down the road you're going to ever have an IRS issue or not if they come visit you. Also, it will determine whether you have good records to take all the expenses you possibly can. So get in a system. There's good software out there. There's Quick in Real Estate. There's QuickBooks. There's all kinds of nice software you can get out there. There's spreadsheets, Excel you can use. And there's also, you can use your own checkbook and design your own little forms right off the Schedule E, like we give our clients to hand out to them every year for our Amish clients, especially that don't have access to software and computers to keep records on and go through their checkbook. It makes timing to do the tax preparation work a lot less time spent, and you get a better understanding as you're going through your year on whether this thing's cash flowing for you or not. So do keep a good system of accounting records. All right, let's talk a little bit about, you want to intervene on anything at this point?
Yeah, I just have
Structure or
a
anything?
question. Yeah, I just have a couple questions. I guess we're into, but how many people in here are currently flipping or want to flip properties? So, okay, so a handful. And how many people are renting or want to rent properties here? Rent properties. Okay, so majority of them for rental. So we might try to focus a little more heavily on that. The big thing that you have to remember when you're flipping properties or renting properties is that flipping properties really is a business. It's not investing the same way that rental properties are. So flipping property is the same as having a construction business or something like that as far as the accounting side and the tax side goes for it, for the most part. It's a lot different than rental properties. You don't get depreciation. You don't get some of the tax benefits that you get with long-term rental properties. So just a kind of important distinction to make that even though we call it investing, it's really more of a business than actual investing. So from a tax perspective tonight, keep that in mind.
The IRS looks at, if you don't mind me intervening, the IRS looks at that as either active income or passive income. Rental real estate, for the most part, long-term rental real estate is passive income, and it's taxed differently than if it's active income, especially if you're not 4029 exempt. There's a lot of Social Security that can be applied, FICA taxes that are applied to self-employment tax for ordinary active income as opposed to rental income. So be aware that there are differences, and there's differences in income on what you can end up taking as a loss on a property depending on what your income level is. You don't necessarily lose those losses, you get to carry them forward if your income's too high to take a loss, but it can be, the threshold I think is around 125,000 or somewhere in that neighborhood,
Almost up to 150.
where you end up losing the allocation at 125 through 150. It starts progressively getting less and less of a loss that you can take until you can't take any loss on it at 150. And at that point, you just have to carry it forward.
Is that a loss on active or passive income?
I'm talking passive income on it.
Okay.
If it's active, it's a loss.
So you're saying so for rental for property that if your income were above that, and you took a
Yeah, what Eli was asking about is real estate professional, somebody has over 750 hours and more than 50% of their time devoted to something with real estate. So that's a realtor, construction, somebody does development, anything that's related to real estate. If you have more than 750 hours, over 50% of your time that you work devoted to that, you become a real estate professional, which would allow you to take more losses than you can if you're not a real estate professional. So you do get some advantages in those cases. Like when you're a realtor like I am, you have rental losses, you can take that as losses, more of those losses against your other active income. So there does become more of a benefit there if you can be classified as a real estate professional. If you have another full-time job that's not related to real estate, it's not gonna happen at this point. So you have to be pretty well devoted to at least construction, if not investing in real estate. We might come back to some of that too, but on the entity structure, how many of you have either a partnership or an LLC set up at this point? Okay, so quite a few. So tell us why you guys chose to do that instead of just having properties in your personal name, or if you have properties in your personal name, why you did that instead of doing an LLC or partnership?
The reason I did it was because I was buying my first rental property, and my accountant said you've got to have an LLC, it's for liability protection. And I guess it wasn't my accountant, it was my seller's lawyer said you really need one. My seller said you've got to have one. It's the way it's done nowadays. People sue like crazy, and you just got to have it. So I ended up not getting the property, but he gave me the LLC for free. So
That's that protection.
and it's not like I knew anything about it. I just did what he said.
How about anybody
It's a
else?
free LLC, how often?
Yeah, free LLC, I'll take that one.
That's
I've never heard that
order,
before.
isn't it, right?
And then 3 years later, he did sell the property.
Okay.
Good.
How about anybody else?
When I started, I would have had a couple rental properties for probably 5 or 6 years before I started full-time in the business. And I just had everything in my personal name at that time. And when I started the business, I just felt like I needed the LLC. Looking back, I never really regretted it, but I don't feel like I would have needed to in my current situation. I think it's debatable.
Is, having everything in a personal name like he was saying, is that dangerous to keep it there? If you have some properties.
It can be. Tom's probably better to talk about the legal aspects, but liability insurance policies are not terribly expensive when you're starting out either. And there's some issues where if you let's say have an LLC, you buy a property in it, and then like Jake, he does all the work to his properties, and I don't know, you manage some of your own too, I think, right?
I manage all my rentals.
And he manages all of his own rental properties. So the problem there is, he has it in an LLC to try to get protection, but then he's, renting it out, he's doing all the repairs, he's the one that gets all the phone calls and everything. So if anything happens there, they may not be able to sue the owner in LLC, but they're going to be able to sue the person who's taking care of everything. So it's kind of self-defeating to some extent in that purpose. Pennsylvania, the claims are usually less than the insurance liability covers in Pennsylvania, is my understanding. Is that right?
Sorry, say that again?
The claims in Pennsylvania are usually less than the liability insurance covers
Oh, sure.
for the most part.
Absolutely.
So if you have liability insurance, it's gonna protect you to some extent from that. LLCs, what do you charge Tom to set up an LLC?
State charges you $125, and simple ones we usually end up with about $600 into it, so $725.
So $725, you get it set up. And Kevin, what do you see? If somebody has, one rental property on a tax return, are they making $725 in the first year?
Typically, to me, it just doesn't make sense if you're only a part-time investor and you're gonna buy 1 or 2 properties to start an LLC. As an accountant, I don't see a lot of sense in it. Maybe there's liability reasons, certainly talk to Tom or somebody like that with that idea, but for that type of investment, I just don't see starting an LLC for it and put it in your personal name. You can buy plenty of insurance to cover it. Typically, they don't sue you over that coverage, and that's why I say that. But With the LLC, it's not a big tax deal. You do have one additional tax return to file with the state called the RCT tax filing. Depending on the value, there's kind of a computation in there that has to be done for net worth as well as 5-year averaging of the income. And you may end up paying some LLC tax currently. That's through the last couple governors has been trying to get through either getting rid of it or leaving it there, depending on which side of the fence you're on. It's still there for now, and who knows where it's going to go. Did you hear anything lately? Anybody on the LLC tax? I haven't heard anything talk about it, so it's still there at this point.
Depends who wins in November.
Yeah, it depends again, and that, who knows?
Yeah, the capital stock tax.
The capital stock tax is what I'm referring to. It's on the form RCT, so if you're an LLC, you must file that form. That's a separate tax form if you prepare it. So that costs you a little bit too to file that form, as opposed to having a single member LLC, which is just can be filed as a Schedule E or as a Schedule E with that. If you were just on your own, you just file as a single Schedule E as part of your return. You don't have to file a separate return for the state, Pennsylvania State RCT. There's also, you can go to the next level and say, I want to have real protection for the amount that we have, and then you go to an LP LLC setup where the LP owns the property, and then you don't have the RCT tax hitting you. And that's for property with a fair amount of value, $1 million or more. You can look at that kind of rule of thumb and say, what do I have in it, and get somebody to give you advice on the tax side if that makes sense to actually form two entities. LP owning the property, the LLC being the general partner. Typically, that partner only owns 1% of the LP, and you avoid the LLC tax that way, the capital stock tax that way.
And that can work really well, like Kevin said, if you have a larger property, or if you have multiple people involved, or syndication. I've done some syndications too, and Dave does syndications, where you want to have control, but you want other people to invest. You have limited partners, they put their money in, they get some money back, but you have all the control over what happens with the property, when, what rents are, what improvements you're doing, where you're spending money, what you're doing for financing, whether you sell the property or keep the property, you can have all those controls. But in the LLC, so there's definitely a lot of situations where the LP LLC setup can come in very handy for you. But like Kevin said, for owning properties in your personal name or an LLC when you're just getting started, I don't really recommend it. I have some properties still in my personal name. I bought properties this year in my personal name. And I have, 4, 5, 6 LPs and LLCs set up for different properties. But I just don't personally really see the risk. Some people don't want their personal name on deeds. So that's a reason sometimes people set something up if you have some businesses or something. They don't want to know, especially if you have a property management company managed. You might not want the tenant to know even who the owner is. So sometimes there's other reasons for that. But we see a lot of people get excited about real estate, buy a rental property, and 2 years later they want to buy their own house, they want to do something else, and they sell the rental property, and they already set up the LLC, and then they leave the LLC open for 3 years, pay $100 or $200 a year to get the return done, and then eventually close it down. And they spend more money on the LLC than what they ever made on the rental property. So, there's some different reasons, I guess.
There's some good legal reasons, however, if you're going into a partnership, to definitely entertain LLC status. Absolutely. Look at that real hard.
Yeah, this is for like individual or you and your wife. If you're looking at doing things with other people, then definitely an LLC or something is what you want. And you always want to make sure that you have, if you have a way to get out that's fair to both parties, because as Kevin can probably attest to, most partnerships do not work out long term. So,
Does an LLC make a difference if you're flipping properties?
if you're flipping properties, there's probably a little more risk there. But at the same time, you're still going to have insurance. If you're flipping properties pretty regularly, like these guys are up here, you're always going to have other properties in there. If you're only doing like 1 or 2 a year, where you might have nothing in there for a while, so if somebody sues you, you don't lose anything. It might be okay. It might be better. If you're Social Security exempt, you don't get a lot of the benefits that you might otherwise. If you're not Social Security exempt, and you flip the properties, usually have people, if they're fairly successful, set up S corporations. You can do that as an LLC, and take wages so that we can limit the FICA and FUTA taxes, the employment tax that you have to pay, if you're not Social Security exempt. So, if you're Social Security exempt, you don't have that to worry about. So from the tax perspective, is not necessarily as important. We do that.
I would say that though, there can be more consideration when you're flipping properties. For example, if you were 10 years ago following the code and you were putting stucco on a house and you were doing it individually, you could be very liable for that even down the road that far. If even that was done by code and certified that it was okay by code back then, but if there's mold issues in that place that showed up 10 years later, that's an issue that you may have to deal with legally. An LLC can help at least put as I understand it, Tom, an LLC would generally put a wall around that arena that you're just gonna work with if that was the case where you did that work.
A wall around.
Overall, around that problem, that issue, if it was stucco and mold and things in the house that had been done. I just know of a case right now where there was a construction company that had done a development back 10 years ago, and they're still getting sued over stucco that was done properly, certified by the code inspection, passed everything did back then, but there's mold issues. It was not a good code inspection to have. It was not a good code to have, and those companies are ponying up right now to do that. And the worry is maybe we should have closed that LLC that they had a couple of years ago instead of keeping it open, because now it opens up to what they're doing now. So they're slowly trying to get out of that.
Well, I know a company that actually closed down a couple of years ago because they were already starting to get too many cases. So if you're in construction and flipping properties, it definitely the legal side has more issues probably
I think so.
than what you have
So
maybe.
get a good legal opinion when you're in that. I would think you'd want get value there.
But you see that all the time with builders doing developments. They'll do a new LLC for every development they do because they want to be done and close that out and move on from any potential liability down the road. So
The properties that you have, that you buy in your own personal name, are they leveraged?
some of them are, some of them aren't. So, but I buy everything in my name. I buy most of those in my name and not my wife's name. So they can only get so much even with that too. So there's you can buy stuff with you and your spouse. You can buy stuff in your own name, and depending on how you have that, people can come after more or less of your assets. Is my understanding. Depending on how you have things titled. So how you have things titled is something you definitely want to talk to your attorney about when you're buying properties. We have our personal residence in both names. So I have some of the smaller rentals in my own name. I usually only do single family rentals in my personal name for the most part.
I mean, I don't know, I guess I find it a little risky with a high net worth individual especially buying properties in cash. Because that's one of the first things a lawyer will look at is, is there low-hanging fruit? And I don't
Well,
know.
this depends what I'm doing with the properties. If I'm planning on keeping them more than 2 or 3 years, they're leveraged. I have a couple properties I'm going to develop into some bigger multi-family stuff within the next year or so. So they're going to be pretty short term, and then they're going to be turned over to something else. So yeah, but yeah, I would agree. If there's nothing, if you're high net worth and you don't have any debt on it, you get sued. People are going to come after you, whether they're right or not. They're going to try to get you to settle or something. The LLC part, definitely if you're getting bigger and you're getting more rental properties, it can help to some extent with tax preparations to have everything in one entity together. Definitely have some liability protection as well, and it's just a lot of people find it easier to keep records just like they would for a business, and then you get more property. So definitely some advantages there. And also, if you're doing any family planning for the future, if you want to pass things on to your kids and stuff, there's things you can do with partnerships and LLCs that you can't do in your personal name. There's things you can do maybe in your personal name too that you can't. But there's a lot of different things that can take place if you're looking to pass properties on to your kids. There's family limited partnerships, where you get discounts, just a number of things. So if you get to that point where you're thinking about that, you really need to sit down with a tax professional and get some specific advice for your situation. Any other questions on business structure, what the tax consequences are, Tom?
Can you talk a little bit about the difference between an organizational structure for Pennsylvania purposes and what that means for federal purposes, and where they can be different and why that is?
Yeah, Pennsylvania is not, there's not a whole lot of advantages or disadvantages one way over federal from Pennsylvania. Some states are a lot more, lean a lot more that way than Pennsylvania is, probably with the differences between state and federal. The LLC tax, the capital stock tax, that's one of those with LLCs. So if you go to a national seminar, they're going to tell you set up an LLC because most of them don't know that Pennsylvania has extra taxes that you make a hit with when you set up an LLC. So I had a lot of people that do that, and then they're like, oh, we have, with large buildings, and they get hit with the capital stock tax. But most of the rules for Pennsylvania and federal are going to be fairly similar. There's some depreciation, which Kevin may talk about, differences between what the federal government will allow for depreciation and what states will allow for depreciation on some assets from that perspective. But you know, I think of much else that's going to,
Definitely a tax rate difference.
yeah.
3.07 on standard tax for anything in Pennsylvania, capital gain or otherwise, in Pennsylvania versus your federal, wherever you're at.
Yeah.
Depreciation rules are different. Even last year when we had section 179 to 500,000, when we had bonus depreciation at 50%, when we had special little rules that we could take for leasehold improvements and things like that available to us, that was all last year. We're in a new frontier. We don't have section 179 at 500,000 anymore. We have section 179 at $25,000. That now matches the state, because the state was always at $25,000. So there, they match finally. That's not good news. So,
This might be a good time, Kevin, for you to get into asset allocation and depreciation a little bit.
write your legislators. Tell them we need section 179 back to 500,000 or at least 250 for most businesses. Could really absolutely use that. Hopefully Washington will wake up to that fact before they get too far down into the year, because it makes difficult tax planning. In 2012, they didn't do anything until January of 2013, and they extended the Bush tax cuts, is what they call it. And January of 2013 made it retroactive all for 12. So it was really tough for tax planning back in 12 for clients, because we really didn't know what they were going to do. Didn't know until January of 2013 they finally made a decision to continue their section 179, their bonus depreciation, which those things can affect your asset allocation studies that you do. Dave, you do a lot with asset allocation studies on some of your projects. Have you ever, what's the limit that you see in your mind that you feel like this doesn't make sense to do?
Well, you mean the price of the asset? They say around 300, 350.
That's what I've heard. I've even heard as high as 500, depending on what the asset is, commercial versus residential use. But your 300, 350 is about right. So I think that's a good rule of thumb for people to use. There's firms that actually do that. My firm does not do allocation studies. We have an alliance with a firm out of Campbell that does that we work with. I think they're very reasonable, probably as reasonable as I would be to go out and try to get my certification in it, and they do an excellent job with it. We certainly would encourage our clients, if that makes sense, to have that allocation study done. And 350 seems to be a good number to look at from a dollar range. And I would say either commercial or residential. If it's 350, run that past somebody that understands those kind of studies and see if it makes sense to their mind. Does it make sense? Certainly, a building that may be just a warehouse building will have a whole different structure to it than a medical health center building that you may be investing in. So those kind of things can certainly affect what your asset allocation would end up being. Any questions on asset allocation for studies?
Yeah, you had talked about single-family homes, duplexes, allocating some yourself. Can you go into that? I really wasn't aware that you could do that other than...
I'm saying I've seen it done, and I haven't seen it challenged a whole lot by the IRS. Typically, they don't challenge a lot with depreciation if things seem reasonable, but it's when it's unreasonable that they definitely will knock it out. But I think I also said, if you didn't hear that part, I want to say it again, that they could knock out the whole thing because it's not certified. So I've seen it done. I haven't seen it challenged by IRS and audits that we've been involved with when we've allocated appliances and allocated different things out separately to sort of take that 3 year versus 27.
Simply what that if I bought a 2-unit apartment building for say $150,000, I could go in and I could knock out the 2x4s, I could knock out the drywall, I could.
No, I'm not talking like that. I'm talking about maybe major things like just knocking out the appliances separately,
Okay.
knocking
Heating
out the
system,
carpeting
appliances,
separately.
yeah.
If you had parking lot, maybe allocating that out as a cost compared to the land value. Whereas if you just go by what the value is that somebody says, well, the land's worth, 13,000 an acre or whatever it is, or 20,000 an acre, go by that. And rent the parking lot, that parking lot, you might be able to segregate that out. I'm saying that kind of thing. That thing to me makes sense, not the 2x4s that don't go to that depth. They definitely won't accept that, if that ever got looked at.
Yeah, what we're talking about with asset allocation is going into properties and breaking out things. There's different depreciation lives for different properties. Residential property has 27.5 years. Commercial property has 39.5 years. Some appliances are going to have 5 or 7 years, depending on what they're for. Land improvements are 15 years, parking lots, things like that. So there's different lives. The lower you can get that, the faster you can get your tax savings from that. So that's what we're talking about, is trying to break down appliances, roof system, carpet, heating system, parking lot, driveways, different things like that we might be able to either expense at either right now or at some point soon, or that we can at least take a shorter life on for depreciation. So if you if you spend $100,000 on a residential property, you're going to put probably 20% of that to land, so you're going to have $80,000 you can depreciate over 27.5 years. So you're not going to get all of those savings back from that depreciation until you're at the 27.5 year mark. If you can move at least some of that to 5 years, 7 years, 15 years, you're going to be able to move it up. And then also by breaking it out, if you put a new roof on, then you can deduct the portion that was allocated to the roof originally. In the same years you put the new roof on, and you have to depreciate the new roof over 27.5 years. But you at least get some of that money back sooner. If it all goes in as one lump sum, and you put a new roof on 3 years down the road, the original cost still gets allocated out over the 27.5 years when you bought it, and the new roof gets allocated out over 27.5 years when that went on. So there's, even if it doesn't make sense necessarily in the first year for the cost segregation study, by breaking it out, a lot of times you can get more of those expenses up front. The big thing you got to keep in mind though is, I've seen people do this that are making less than $50,000 a year. They almost pay no taxes anyway, and they're talking about getting a cost segregation study. And they're in a situation where they're likely to have a very high income within 5 or 10 years. In that situation, they're not going to get any savings anyway, really, this year for doing a cost segregation study. So they're better off really just letting it go for the 27.5 years, taking as much of it as they can later when they're in a higher tax bracket. We have a graduated tax system, so you can go from nothing up to 39.6% right now. So you got to keep that in mind too. If you're already not paying taxes, it's not going to make sense to do it. Kevin and I were talking the other day, and we said, one thing we're not up here to tell you to do is how to pay 0 taxes. So that we, never really met anybody that's terribly successful that pays 0 taxes. If that's your goal, we're probably not the guys to talk to. We might be able to do that once or twice, 1 or 2 years in your lifetime, but hopefully not a whole lot, because that generally means you're not making a whole lot of money overall. So,
Now, I want to be clear, if you do your own asset allocation yourself, that will not hold up to an IRS audit. Just want to be clear that that's not acceptable. I just haven't seen them really dig in that deep a lot of times to worry too much over whether something was a 27.5 year item and you took it over 7 years or 5 years just because it was appliances. It's a couple $100. It's not a big deal. It's not a lot of difference. I'm just not seeing them really dig that deeply into most things. When they get into an audit, they're looking at more specific items for reasons why they're going to audit you. Usually it's not because your depreciation is just a little off kilter. But they do have the ability to say this is wrong. You're not certified, man, you owe us this back. And just understand that. If you do your own certification study idea, okay? If you pay for somebody who already does it,
He's paying.
and in a building that's, like I said, if you've got a building that's 400, 500,000, depending on what it is on upwards, it may well make sense to go get a study done and allocate those out by all those different, basically, units of property, UOPs.
So this is, so you said that doesn't necessarily trigger an IRS audit, but what does? What things should my tax accountant not
flags that'll trigger an audit, and they'll always say, no, you were random, so they'll never tell you that it was actually a flag, unless it's specific to something that they're specifically looking at. But, you know, differences, variances in income, that can happen. Variances in expenses, that could trigger something. Certainly variances in different types of income can trigger that.
I have an associate that just got audited last week. He was paying one of his contractors under the table. And I think that was what they ended up, and they said it was a random audit that they paid.
They say that, but it rarely is a random audit, in my opinion. It's usually been on something that somebody looked at. Certainly, if you ever get involved with real estate and you're doing a 1031 exchange, you know what that is? Everybody knows what a 1031 exchange is? 1031 exchange, I'll just briefly say, is where you basically have a property with a basis of X amount of dollars on it, and you want to defer the capital gain because you're selling that property. If you go buy another property thinking, well, I sold this, I'll just buy this one, isn't that okay? Now I can defer it? No. You've got specific rules applying to section 1031 that basically you need to get two to three people involved that really understand it. First of all, a really good attorney that understands 1031 exchanges. I've seen 1031 exchanges done by some attorneys, nobody in this room, I can tell you that, but I've seen some already from outside our area that we didn't take as a tax account because they put the position worse than if they wouldn't have done it in the first place. Or we suggested that they wouldn't take it anyway, and they didn't for the most part because it put them in a worse tax position. Just because you're trading bases doesn't mean that it's always in your best interest. So make sure you get a good advisor up front to tell you how you're following the correct rules. And Tom, I know, understands 1031 exchanges. Am I correct? You feel real comfortable with those? I would certainly say that's where, you know, you want to go pick somebody that certainly has that ability to understand that. The second person is make sure your account also is in sync with your attorney, because they got the same burden of due diligence to make sure they're following through with your 1031 exchange. Every exchange, as I understand it, is looked at by human eyes in the IRS. And they're looking for ways to say, this didn't cut it. You can't defer that gain. You got to pay it now. That's their rule. And I understand it's not a computerized driven flag thing like a return may be going through some kind of rigorous flagging of computerization techniques and statistics. It's basically got a pair of human eyes looking at that and looking for something that reason they can crash it. Tom, any comments on that? Is that about a fair statement?
Yeah, it is. I think certainly when you have a qualified intermediary involved, they get a lot less scrutiny than the other ones.
Correct.
If you try to do it without a qualified intermediary, or you're doing a direct swap, or you're trying to use a friend as a qualified intermediary, I think those get scrutinized quite a bit. I would suspect.
That's absolutely right.
Yeah, the other thing you gotta keep in mind is there are a lot of dates involved with Lake County Exchange, and if you miss any of those dates, you lose it all. So you gotta have everybody, I would have the realtor in.
Yeah, I'm sorry, did I say
Yeah,
three?
you said three.
I missed the realtor, and
That
that's
was
the
one
other
thing
point, I
about-
wanted to make sure that the realtor has done that before, has some understanding of that, because that's the third.
Because the realtor has to understand they're under a lot of pressure to find properties that are good properties too, for the person buying the right time frame, potentially. And you wanna make sure that you get somebody who's not just gonna put you into properties so that you can save a little bit of taxes. You gotta really make sure that you understand how much how much you're saving and what you're paying for a property. I had a situation earlier this year that you have to identify properties in a certain period of time. We had done that. We had one we felt was gonna go to settlement, and about a week before settlement didn't happen. We only had 15 days left to settle another property. We had to have that identified actually 3 months earlier. So it wasn't even on the market at the time we needed to get it. So we were able to contact the seller, get under agreement, settle it in the 15 days for that because we had identified it early on. It turned out that the buyer couldn't get it quite as cheap as what he wanted, and paid about an extra $5,000. He was going to save $25,000 in taxes, is what his accountant told him. I wasn't doing his taxes. I don't want to do both sides of these, but his accountant told him he was going to save $25,000. So he was fine with paying a little bit extra because that's the only property he had left at the time to save the $25,000. So you got to make sure that your realtor understands that there's a lot of money on the table, and things don't always go the way that you expect them to, especially in Lake like-kind exchange when you're under that. And once you get past the 45-day period you have to identify properties, you have a very limited number of properties that you can identify, and you have to know that you can get one of those settled in the time frame that you have in 6 months of your prior sale. So we cut that one pretty close. So fortunately got it through.
When you say like-kind properties, define that.
Yeah, like-kind properties, basically almost any type of real estate is gonna be like-kind. Now you can't exchange different classes of real estate, which means like residential property that you live in. So you can't do a like-kind exchange with your house that you're living in for an investment property. So if you have a piece of land that you want to sell for multifamily, you can do that. You can sell multifamily for commercial. So there's a lot of different things that you can do. In some situations, I think you can do oil and gas if you have the right people and you do it right. So there's a lot of different things that you can do within the real estate, but a lot of it's based on usage. It has to be investment use versus personal use. So, and then there's rules if you're going to do it. You can do it between family members, but there are rules on how long you have to hold the property if you do that. So you can't just do like kind of exchange with your brother to save on taxes and then he can go out and sell it in 6 months. He's got to wait a certain period of time before he can do it. So.
I think 2 years.
What happens in a situation, so you get aggressive with your cost segregation, I haven't done a whole lot of studies on this, I haven't sold a whole lot, but let's say you bump a lot of your depreciation up to the 5-year window. Year 6 you sell. Do they then turn around and recapture most of that, or is that burned off?
That's a good question. And what happens, unfortunately, is not in your favor. Basically, that's recaptured as ordinary income.
Usually at a higher tax, what that means, usually at a higher tax rate than what you were able to deduct the depreciation at.
Since you deducted as ordinary income back when you took it off, it would be deducted again as ordinary income, not necessarily capital gain. So you wouldn't get capital gain treatment, you would get ordinary income treatment.
So when you go to sell a property, right? When you go to sell a property, you have 2 things that you really have to have for tax purposes. One is the capital gain, and one is depreciation recapture. What Kevin's saying is depreciation recapture comes back in at your this is taxable income, which means it's taxed at whatever tax rate you're at the time. The capital gain right now is anywhere from 0 to 20%, depending on what tax bracket you're in for that. So the gain would be basically if you pay $100,000 for a property, let's say you depreciate $20,000, and then you sell a property for $150,000. So what we call your basis is $100,000 less $20,000 depreciation. So you have a basis of $80,000. You sell for $150,000, so your gain would be $70,000. But out of that gain, you have $50,000 of taxable income at your regular tax rates, and you have $20,000 at your regular tax rates, and then $50,000 at the capital gains. So if you're above 20% in your taxable income rate, then you're paying more on the depreciation recapture than what you are in capital gain. So again, a lot of this goes back to you really need to know what your plans are when you buy a property. So, if it's a property you're going to hold for a long time, you think then it's probably worth doing the cost segregation. If it's property that you're really fixing up to resell within a couple of years, which some of you guys do, then it may not make as much sense to try to pay extra money to get that depreciation up front. Because you really might not end up with a whole lot of tax benefit from it anyway.
And the other side to understand that, if you say, well, I'm just going to do it on installment sale, and then I'll just have to count that as I get it. Recapture happens that first year. Depreciation recapture, whether you got that money or not, you're going to pay tax on all that recapture the first year, whether you got the money to pay it or not, doesn't matter. That's how that rule is handled. So there, Dave, in that example, you may want to, really look hard at a 1031 exchange, a like-kind exchange rules, and say that makes sense to maybe defer that tax and defer that capital gain on that whole property to something else. But your basis is certainly reduced by doing that upfront cost segregation study. You certainly reduce your basis in that property. So there's some definite factors involved. Again, like Ron said, it can make sense if you're keeping it long term. Definitely, that makes sense to do those studies.
How much past the 5 years is that applied for?
past the what the fuck.
Like, he was saying if you sell at year 6, well, how much longer do you have to keep it to get away from that?
So on the recapture,
Yeah,
you don't get away from recapture.
oh, you don't?
So what you're saying is if you buy a property for $100,000, doesn't matter what you depreciate, your capital gain is based on your sale price above 100,000.
Correct.
So
Not recapture above that.
it doesn't matter whether you depreciate it down to 30 or down to 90. The 1031 tax exchange can be utilized on the difference between your purchase price of 100 and what you sell.
On the total. Yes.
Yeah.
The 1031 can be used for full amount. So, you don't have to pay the recapture. You don't have to pay the recapture with the 1031 exchange. That's what,
Okay,
you
so
do that to avoid the
You don't have
recapture.
to, you don't have that issue, and that's why it makes sense maybe in his example to look at that.
so you're saying 1031 wipes out getting charged recapture tax?
At that moment.
Alright.
At that moment.
Yeah.
It'll kick your can down the road.
Well, I mean, if you're making, if you're saving 20,000 in taxes and you're making 15% a year on the money, then why not make 50% a year on the government's money?
That's right. That's right. You got the idea.
So what does it cost to do a 1031 tax exchange? Can you get into a little bit of detail on that? Like, so say I have a $400,000 property and I depreciate it down to about $250,000, and then I want to sell it, and it's probably going to bring around $600,000. So I have, say $350,000 of gain there. I mean, at what point? At what point is it worth it or not worth it to 1031 taxes?
I've seen 1031 exchanges cost between the accountant and the attorney on properties anywhere from a few $1,000s to $40,000 or $50,000 of cost.
Okay, for this particular
For
property.
that particular property, Tom, your side of it would probably be somewhere, it's gotta be up in the 10, don't it? Closer to that, 7,000, 6,000, what are you looking at there?
No, we typically don't see it that high.
Not that high for,
No.
what was your property price, 700,000?
No, 600,000.
600,000, okay, I'm sorry.
No,
So, yeah, you'd be below that, you'd be somewhere, what, 5, 6?
yeah, even by the time you pay a qualified intermediary and you pay attorney's fees, even 3,000 or 4,000 on that side.
So we typically, the accountant runs around half or 3/4 what the attorney charges are. Typically, we get the accountant involved to help out with that, as well as what the attorney charges are for something like that. But a couple of years ago, well, it's been 9 years now ago, but 9 or 10 now, but we were involved with a Raffo Township farm sale. It was quite expensive, and between the attorney fees and the accountant fees, the fees were probably close to $37,000 on everything, but they're talking millions of dollars worth of things that happened. There was a family limited partnership involved. There was discounts involved with that, setting all that up through the next 10 years. It was hilarious because his daughter was a financial planner, and she was pushing Dad to get some opinions between an attorney and a different accountant, which we were her accountant. And he ended up not caring about paying his taxes to government. He never had much money, so it didn't matter to him if he had farms, but he never had a lot of dollars to rub together. So he didn't care so much about it until he sold all this. Is more money he's ever going to need. And the daughter just was driving her crazy because Dad, you can save some dollars here if you do this tax-wise. And when we finally met, the one thing that convinced him was when I started talking about charitable remainder trust or charitable things that you can do with your money if you, instead of giving it to the government, giving it to a different choice. And that's what sold him on the fact that he needs to do this. We ended up saving him about $287,000 in taxes over that process of doing that, for what he would have paid. Our fees were, on that project total, our fees were, between the lawyer and us, we were right around $30,000. And we were fairly close to each other, 15, 13, somewhere in that range. When he got his bills, he happened to get the attorney's bill the same day I sent mine, that he got mine. He got them both on the same day. That wasn't meant to be, because that's not a good idea usually. And he called his daughter up and really just really was not a happy camper, because he's never paid bills like this for an accountant or an attorney. This is ridiculous. These guys just took me over the coals. And then she reminded him how much taxes he saved and how much money he ended up giving to charity, and all of a sudden it softened his heart. And he called me up and he actually felt bad. He kept talking to his daughter that way. He apologized to me. I didn't know he was down talking to me. So he's been a client ever since, and he owns property all over the East Coast. But he's a good guy. But it was a funny story back then.
Yeah.
So anyway, they do make sense. It absolutely makes sense.
So you're saying even on a $100,000 rental property, and we depreciate it, down to 75, 80, and then we can sell it for 140. Even if you have like a minimal spread there, $50,000, $60,000 it's worth.
I think it's worth looking at and worth getting a quote from Tom or any of your accountant to look at it and say, what's it going to really cost to do this process? And here's the property with the realtor that you have examined that you want to get. Does it make sense on the basis side? Because like I said, we looked at one not long ago, a couple years ago, that was sold in North Carolina for a property up here. They did a 1031 exchange. And they should have never did it. It was worse. It put them in a worse tax situation because of the way the trader based it was. So make sure you're looking at it with the realtor what you're doing. There's three parties that you should be talking to during the process.
Is there a lot of work to, like on the tax accounting side, if you do 1031 exchange?
A lot? What
Like
do you consider a
ongoing,
lot?
Say you have to maintain basis in your first property, correct?
Yeah, basically, there's work to do. I mean, if your accountant's already been keeping up with you, he or she probably has all the information you really need to make work through that. So, no, I don't think it's a lot of work. It's really a lot of legal work, which is why the accounting fees are usually a lot less than what the legal fees are. But there's still work to make sure that we documented, that the accountant's documented tax-wise. Because what happens if you got an audit, it happens 2 or 3 years down the road, if you don't have everything documented properly and put it down properly, you're going to remember what you did.
Right.
2 years down the road. I'm trouble 3 days sometimes, so we document a lot. You should too.
The better records you have, the better job we can do. You come in without expenses. We don't know. Kevin and I can't read a crystal ball at the end of the year and know that you put a new roof on a property, a new heating system in, or change the toilet or anything. But you guys got to do the work, making sure you keep track of all of those expenses, and get them allocated to the right property throughout the year, so we have it at the end of the year. So, we both do a lot of properties. You want to make sure you get somebody who does a lot of real estate returns. Because I've seen returns that I've picked up before where the prior year there wasn't any real estate taxes on the return, there wasn't any insurance. Well, if you're involved in real estate, you know that every year the real estate tax is going to get paid, every year the insurance is going to get paid. Especially if there's a mortgage on the property, because the bank's going to make sure that the insurance is in place. So there's just certain things that people who don't do a lot of real estate returns are not going to necessarily pick up, that we might pick up. So, you want to make sure you go with somebody who really has a lot of experience in real estate.
How much time do we have to get, Dave, for us?
About 15 minutes.
15? Okay.
20.
At some point, I want to make sure we cover the new regulations for repairs versus capitalization. So I want to make sure we just save a little bit of time for that too. I think that's
Can you talk a little bit more about 1031? So, I realize you don't have a lot of time, but if we sell our $100,000 property that we depreciate down, and we sell it for $150, the property that we buy will need to be at least $150,000 or more.
correct.
But it could be less.
Could be
We
less.
just wouldn't.
And depending on what boot you get, if you got cash for it, or depending on how you sold it, can also determine on how much gain you're going to have to count.
Yeah, but so say we fully utilize the 1031, the sale price should be above. That's the simplest.
That's the simplest way to think it through.
Yeah.
If you want 150, in your example, you'd want to look for a property at least $150,000 to defer that gain. Or yeah, you could have multiple properties. It don't have to be one. It could be multiple properties made up of that. When we did that one back for the Arapahoe Township, we had 7 properties involved between Florida and New York, involved in that one settlement, or that one 1031 exchange.
So, what made your one 1031 deal so bad?
The exchange of the basis was never thought through. She did a lot less, she bought a property for a lot less than what her property in North Carolina was. I think it was South Carolina, actually, it was Myrtle Beach, South Carolina, sorry. It was Myrtle Beach, South Carolina, for you golfers. And she bought one here in Paradise, which was a lot less, and she just heard, oh, you just exchange it, and that's what you do, and you're good. And the attorney down south wrote it up and did it that way, but it wasn't a good idea. Because basically, that property up here, she probably paid $30,000 for, and she was selling one for $270 or $280, I think. Didn't make sense. And she had more basis in the property as she had down here than she would have bought in this one. And they were doing a 1031 exchange. She paid about $3 grand to have that done. It's a shame.
So you're saying just make sure you don't buy or don't exchange a property that's less than the basis.
If you have a property that you feel like is a candidate, first thing I would do is I'd call Tom or whoever that you feel you're comfortable with. I know Tom knows 1031 exchanges. That's what you do. And you just run it past them. I'll tell you what, the successful clients that we work with are not afraid to go and ask their attorney or ask their insurance guy, ask their realtor, ask their accountant a question. And even if their attorney happens to be 6 minutes on the bill, or the accountant does, or the realtor says, hey, buy me dinner, whatever you guys do on your end of it when you get free advice, do that. Because don't be afraid to pay a bill. It's worth it to get the right advice with the right people. To me, it's worth it.
Yeah, absolutely.
The other thing I just want to mention before we get into the costs versus repairs versus the changes in that reg versus capitalization. If you guys get involved with things locally, I really encourage you to do stuff like that. I was involved with Paradise Township as a supervisor for 12 years. I'm involved as chairman of the board of the newest bank in America, Bank of Birmingham. So it's a great bank. If you're looking for a bank in that area, please come see that bank. I'm involved in some other boards. You really get to networking with people when you do that. And networking with people that have similar ideas on what you're trying to invest in and concept-wise. And you really do learn a lot outside of even being in meetings like this, which I hold high regard for. I really commend you for having this kind of meetings. This is awesome. But get involved with things too outside of investing but with like-kind ways of talking things through and networking with people. I really encourage you to do that. That's a good way to learn. That's the best way to learn. All right. Any other questions on anything? Go ahead.
And this might change the subject a little bit, but is there any way that you can take your money from an IRA and invest it without having to pay a penalty?
How old are you? You don't look like you're 59 and a half years old. You can, if it's your first home buyer, you can put up to $10,000 to it for your first home. But as far as if you're going to put it into an investment home, that has to be your primary residence, in other words. If you're going to put it into an investment home, you're pretty well stuck paying the penalty.
You can do a self-directed IRA.
You can do that.
But then there's a lot of things you have to be careful around that too. Then you can't really have any control or anything what happens with it for the most part. So there's certain types of real estate that work well in that. In my opinion, there's a lot of real estate that does not work real well in that, because if you don't follow all the rules exactly right, they're going to say that it's a distribution and you're going to have to pay taxes and penalty on the full amount. So even a lot of the companies that have people set those up and do seminars and everything, a lot of the seminars are, at least in my opinion, I don't know if you've listened to them, but are telling people things that I don't think meet the IRS guidelines that are allowed with it.
I
They
think
really want to be careful.
it's a
with
flag. When you're doing even self-directed IRAs, you better have your T's crossed and your I's dotted when you're dealing with that. Nothing wrong with that, but just make sure you're following, because that's a definite flag. Those areas there are things the IRS looks for. And if you're doing one, they definitely could probably audit you for that reason randomly.
I've done several, in fact, I was working on one today. I've done several self-directed IRAs into my syndication, and yeah, you're right, just, make sure that your self-directed IRA guy is on board and it's not good.
They work. I mean, we have organizers of Bank of Birmingham that use their IRAs as self-directed IRAs for organizing the investment in the bank. So they can be done, but you just got to make sure you're doing
What is a self-directed IRA?
Well,
It's an IRA that's self-directed.
yeah, I mean,
There's,
No,
there's a few companies that do it. You're never gonna hear about it from your stockbroker because they can't make any money out of it. So, or any, a lot of financial planners, but, Equity Trust, Cama, I don't know, you use one of those or something.
Equity trust.
Yeah, are probably two of the biggest ones that you can do, CAMA or Equity Trust. And they basically just act as the broker, they hold all the funds, they write the checks to what your investment are. I've seen situations where, people have tried to do flip properties through self-directed IRAs. I think that's obviously a clear violation of what you're allowed to do with that. Rental properties, potentially can work, but you have to have a really good property manager that you trust because you really can't make decisions on, what to repair and when to repair it. So there's just a lot of things there, limited partnership, interest like Dave's doing, hard private money loans potentially. The problem with that is if somebody doesn't pay you back and you have to foreclose, I'm not sure then that would even meet the standards, or else you'd have to pay somebody else to handle it all, which would probably be more expensive than what you want to pay to do that. So even private lending can be tough with that. So it's just pretty difficult, in my opinion, to have, other than limited partnership interests, to do a whole lot with self-directed IRAs in real estate and have it fit. I mean, self-directed IRAs are not real old, and there's not a whole lot of money in them. So we haven't seen the IRS come after them yet. I always tell people, I figure that 5 years from now, there's a lot more money in self-directed IRAs, and the IRS sees that there's a lot of money to get there, that's when they're going to hit them. When a lot of people have made mistakes with it, that's when they're going to come back and hit people. You get 10% penalty plus your tax rate when you took it out. So there's a lot of money there for the IRS to get.
Self-directed IRA is basically you take it out of the stockholders and you invest in yourself.
Not necessarily invest yourself. You have control over it. There's a lot of things you can do with it too. It's not just real estate. You can do gold, you can do sheep, you can do stocks. Yeah, you can still do stocks. You can do almost anything you want to do.
There's only about I've seen the list of things, and there's only about half a dozen things that you can't do.
Right.
There's very few things that you can't do.
Right.
And typically the investor, like Ron said, doesn't really want to get involved in a whole lot because they don't make a lot of money off of them. Obviously, they got rules they've got to follow, and they usually do an upfront charge and say this is what we're going to charge you per year for taking care of it. When the Bank of Birmingham knew we had interested parties who wanted to use self-directed IRAs as organizing money, we went out and searched out, and we found Ron Bear with Bear Financial to be very reasonable on his fees that he would charge to set them up. So I commend Ron for coming to have reasonable fees to look at what a self-directed IRA would cost, but there's still an annual cost to have that. Somebody who just invests regular money doesn't have that charge.
Is that an upfront cost or is that a yearly cost?
There's an annual charge. I think his charge was $500 to do that transaction, regardless of what the amount was. Something like that, if I remember right. But it was the best charge there was. It was the best cost there was. We had much higher ones when we helped people search for that.
And you'll find when you talk to your traditional or your SEP IRA or whatever, you'll find that they're usually not too anxious to help you get it over into the self-directed IRA. It can take 2 or 3 weeks sometimes.
Oh, it can take longer.
Yeah.
I don't know how that happens. They're just busy.
Still in on my dad.
Yeah.
Because at that point, they don't make money on it. They make money when you're invested in the market and they're controlling it.
Any other questions before we move on to the next topic real quickly? We'll run out of time. What I do want to cover, there's been in 2014 a major change to how repairs versus capitalization is being done. Anybody familiar with that change yet? You read the regs? Come on, guys, I'm excited.
That's what I say, other people do.
Is that right?
I'm catching on.
It's good. It's good. You still got to be aware of some things, though. You've got to understand what somebody's doing so that you can track it correctly. Okay? The regs have changed. We had some rules of thumbs we always used in the past and things like that, but now I want you to remember, am I right on this board?
Yep.
Dave?
You can erase off what I wrote on it before.
Anybody
BAR stands for an acronym that stands for Betterment, Adaptation, and Restoration. If you meet any of those definitions in your transaction that you did for your rental property, as making a betterment to it, an adaptation to it, or a restoration to it, you do not have a repair. You have something that needs capitalized. What does that mean? It means it needs to be depreciated. It could be over 27.5 years. If it's commercial, it could be 39 years. If it's some segment of that, because you've done a cost segregation study, part of it, it could be less than that. But that's what you're looking at. If it's a betterment, if it's any kind of an adaptation to it, or if it's a restoration, that is right out of the tax code. So what's that mean if it's a betterment? Well, it's easier to think of what the IRS came up with as their concept of what's called a unit of property. So let's discuss that first. It's a UOP, and then this will make more sense as we move into the acronym of the BAR. A UOP is a unit of property. What the IRS says is, in the past, you really only had one unit of property to worry about. That was the building. And it was 27.5 years. Of course, if you decided to kind of do your own little thing with segregating some assets out, you segregated that over the whole building. And let's say you had a repair of an HVAC, a heating unit, or an air conditioning unit on your residential rental property. You didn't replace the whole unit, but you had to do a major repair with it. Let's say it was a compressor. Well, the compressor might have cost you $1,000, and maybe the service on it was another $500, so the total thing was $1,500. But when you looked at the total unit of property as being the apartment building, $1,500, and it's a $250,000 apartment building for 2 units, well, that's not very significant to the whole property. So let's write that off as a repair. And usually you won those kind of arguments if it ever became to that case in an audit, because it was insignificant or immaterial to what the unit of property was. But the new regs that start here January 1st of 2014 say we now believe there are now 9 areas, 9 classes, 9 units of property that have to be dealt with. And I'll read them off to you. Basically, those 9 areas are heating, ventilation, HVAC, here's my email, I lost my page, HVAC system, a plumbing system, electrical system, escalators, elevators, fire protection, alarm systems. If you have access to the internet, it's all there too. If you ever have access to the internet, go look it up under UOP. Hopefully you'll get the right thing, unit of property. I'm not sure what else you might get these days, but unit of property is what you want to look at after you do rental real estate. So again, HVAC system. Number 2, plumbing system. Number 3, electrical system. 4, escalators. 5, elevators. 6, fire protection and alarm systems. 7, a security system. 8, a gas distribution system. And then, of course, you love the IRS for number 9 because that's the catch-all. Any other system identified in IRS publications. So what it's done is it's taken the envelope of the building itself, or the whole building idea, and divided it up into these 9 systems. Now it says that you did a HVAC $1,500 repair, and your whole system is only $3,000, or that's what the cost of that IUP would be generously done. At $3,000 cost, and it costs you $1,500 to repair it. That's a 50% of that IUP, or that UOP. That's a 50% of that. Instead of being a small percentage of the total building, now it's a pretty significant percentage of what that system is, what that unit of property is. Now they're going to say, no, you can't expense that. You need to capitalize that. And oh, by the way, that's 27.5 years. Because it's part of your building. It's a UOP. So they really have not made it friendlier to us real estate investors in really breaking down that system into 9 various systems.
But if you had a cost segregation study done, you could bump it up to
you had the cost segregation study done. What do you typically pay for a cost segregation study for a multi-units where you only got 4 or 5 different units, maybe? A couple $1,000, $4,000 or $5,000?
For fourplex, probably 2,500.
And 2,500, okay. For a fourplex?
Yeah.
Yeah, okay. Okay. So you gotta, let's consider whether it makes sense again, go back and do a study for your particular property that you own. Yes.
Who's breaking it into those categories and assigning a value to it?
That's where, like, this is such a stupid idea, isn't it stupid, this regulation? Because it puts a whole other gray area. Wasn't it easier before when we just sort of ran by the seat of our pants and decided whether, it's $500, let's make it a repair, it's $1,000, maybe we better think about it, and if it's $2,000, maybe we better capitalize it. You just kind of went on with the idea that if it was an improvement, okay, maybe we better capitalize it. But if it was actual repair, in the old reg, we could do half the roof, and you could count it as a repair, and then somebody would do the other half the next year, and then you counted that as a repair. If you did the whole roof, you had to capitalize it for 15 years or so. We don't have those days anymore. Now we're stuck with this new reg, and it created, in my thoughts, it creates a lot more questions on, doesn't allow you to sort of do what you want with it. What values you want to it, and I think as long as it's reasonable, I think it'll stand up to things on the IRS, but that's not proven, it won't be proven for another 3 or 4 years until they go and audit 2014. So back to bar, what does that mean within that? So within these 9 systems that we're looking at? Well, a betterment is basically something that they're looking at to say, you've taken the property and you've improved its value. There's court cases out there that you can rely upon, I believe, and we do, with respect to betterments. For example, if you had a property that had windows in it before, and they were good windows, but you decided to put better windows in, is that a betterment? IRS would say, well, yeah, of course, that's a betterment. But if you can have a certified appraisal done, if it's a large enough building, it makes enough sense, and have a certified appraisal done prior to you doing that repair or that project, and afterwards having an appraisal done that shows you didn't add any value to it, that's a repair. Pure and simple. There's a court case that's handed down to us that we accountants rely upon for that very, very same. There was one involving a roof structure, roof repair. And that was the same way. They had an appraisal done of the property for a mortgage reason of refinancing. And after they did the major roof repair, they spent a lot of money. They did another appraisal and found out that the property didn't add any value. They relied on that. IRS didn't rely on it, took them to court. They went to court and they won. Not the IRS, that is. The taxpayer won because they showed they didn't increase value. That's better. Increasing value, making it better than what it was before. If you do that, obviously that's a capitalized, that's a depreciated element. It's not a repair. The second A is the adaptation of the property. You do something that changes the use of it. You've definitely changed its structure around. You adapted something to it. You made a remodel in addition to it. Certainly in addition to being in with those adaptation rules. That's something new. That's going to be capitalized. That's not a repair. That's fairly easy. And then restoration. This is where it gets a little trickier because there's examples in the tax code that have for restoration. And typically it centers around about 30% of the cost that you have allocated to that arena. So if you have an electrical system in there and you want to put a restoration to a newer electrical system, if you can keep it below 30%, from what the code says, typically you should be okay with that. But if you're over that 30%, you probably have a capitalized item that you've got to allocate differently for tax purposes.
30% of what?
30% of that original cost that he said, well, how are you going to come up with that? That's what you're going to come up with and allocate out kind of doing. But that doesn't mean you get 27 and a half years that doesn't mean you only get 10 years for electrical system. It's still 27 and a half years. All these are basically 27 and a half years. It's just how you allocate repair versus capitalized, is it a repair or is it actually a capitalized item?
When you're saying capitalized, we're back to the
Asset
27 and a
depreciation.
half year.
Correct, correct.
So what items then can you depreciate in 5 years and 7.5 or whatever?
Client says you can do in 5 years what other equipment like that you can do in 7. So certainly HVAC, that may be something where you could get a 7-year item or even some 5-year items on some of that stuff with respect to the HVAC system. If you did a study, if you didn't do one, that's not going to hold much water if they audited you and took you to task on it, because that's technically still a 27.5-year item according to this regulation.
Does that apply to all tax returns before 2014?
It applies to, well, no, it would only apply to 2004, January 1st of 2014 going forward. So if you use some things 13 in the old rules, great, good, no
Yeah,
problem.
we've done a lot of, like upgrades that we appreciated over 5 and 7.5 years. It's just always what we did. You're saying that's not gonna be the case anymore, just
Not
everything's
anymore,
gonna be 27.5.
yeah, those regs have changed. Looking forward, that's now on, starting with January 1st of 2014 going forward.
So what if you buy a train wreck of a 2-unit for 20,000, you dump 50 into it? How does that get?
You're gonna have to really allocate those out by the, in a sense, what I would do is I would allocate my costs out by those 9 factors between what I just read off to you. So that down the road, when you do repairs or whatever you're gonna do to those systems, you've already got your allocation of cost structure, so if you get to 30% of that, you've already got that kind of structured out already. And now you've got something that you can hold on to show your documentation to the IRS to say, this is what I based it on. And you'll probably win that argument that way. If you have good documentation that shows what you originally started. That's what I would do.
So for example, so you're saying if you spend 7,000 on two
Two HVAC systems.
and then you have a repair coming up for, say, $1,800, you can,
I would
use that as a
classify
repair.
that as a repair,
But
under the
it's-
new reg. So in a way, it has cleared up a few things as long as you start out with the right, with something that makes reasonable sense to what your numbers are starting out with to get to use those
Just if
percentages.
you don't have anything to start out with, that's where the trouble.
And where you're taking a percentage of it. Yeah, that's right. You got the idea. Everybody understand that?
No.
So let's just throw out some examples that might be different this year than they were last year.
All right.
Let's say,
You want to do something on the board there, Kevin?
Sure.
let's say I have a plumbing leak at my own property,
All right.
and I send the plumber out, and he finds the leak, and we end up running a new line from the second floor bathroom down to the basement. Wouldn't have to replace the whole thing, but we're going to anyway, and it ends up costing me $1,200.
Okay.
What is that?
Well, how much did you allocate towards that section of your plumbing to begin with?
I have no idea.
So what's that tell you you're gonna have to do? Probably go back and take a look at things, even though in that property you may have had for a long time, go back and look at your basis in that property and kind of allocate it out to what you think is left in there to do. And that would give you your percentage in.
Or just take the easy way out and put it over 21.5 years. or
Well,
27.5.
let me tell you, there's another easy way out too, at the IRS. They knew this was gonna be confusing to everybody and a pain in the butt to try to keep, so they say, okay, well, we'll make a safe harbor rule, and this will make everybody happy, right? Safe harbor rule is $500. So if you have a $500 repair or item that you did, well, that's a repair. That's a safe harbor rule, and you can use that.
I'll just get
Buy invoice. So get your plumber to invoice you 3-4 different invoices. It's $500. Good to go.
That sounds like the easiest way out.
That's the easiest way. That's the rule.
That's all we need to know.
Now, one other thing, you can actually get it to $5,000 if you go and pay your accountant a whole bunch of money to audit your books. Because if you have audited financial statements, it's now $5,000 if you audit your financial statements. But that's opening up a whole other can of worms because you're going to pay an accountant a whole lot of money to go audit your financial statements just on that. And probably not worth it.
How much?
Give me your books and I'll look at it and I'll give you a price. So I'll bet it'd be more than $5,000. Just to audit. seat and P and here you go idea. So, I'm telling you, that's in the code,
Any
so
repairs to any rental properties, whether it's one.
there's a safe harbor rule for $500 by invoice.
So you're gonna tell all your contractors, you can bill me whatever you want, but it can never be on one bill more than $500. Write him a letter tomorrow, form letter.
So wouldn't there be some improvements that we could make, just to say, prior to this year, that would actually be in the, what do we call it, the building and improvement section of things, like, what would be an example of something that should actually be on the 27.5-year side?
Well,
I guess anything under 500, you're not
let's
really.
think about, let's use this example. Let's say you needed to replace all the sinks in your property and fixtures that way, okay? And in prior years, what you would have had to do was look at it and say, you know, is this really a repair? Because probably it's gonna be a fairly significant cost to replace all the sinks and that kind of an idea. But then when you get your building, you look at the whole building, maybe you can get by to say reasonably, it's not significant to the whole building cost. If my accountant feels good enough about it, maybe we'll expense it as a repair. But typically, the IRS would look at that as a capitalized item because it's part of your real property, and you're signaling that as 27.5 years, okay? And they're looking at that as you made it better. If your sinks were that bad off that you needed to replace them, you made it better, correct? So that's typically, they would have looked at that in the past as capitalizing it over 27.5 years. But under this new method, you basically could say, if my plumbing system was worth $30,000 or $20,000, $20,000, and I replaced all my sinks for $6,000, that's 30%. That's a repair under this. That's not a capitalized item. You now got a repair.
So the 30% is also a hard number that we have to work with.
Yeah.
We just aren't sure.
I think
30% of what?
it really doesn't say that. It doesn't say 30 or 40. It says significant. Well, significant in most accounting terms means something around 30%. But it doesn't give you a percentage in the code.
Okay.
But you may stretch it to 40 maybe and have a kind auditor and you go by with that. And he may not be as kind or she may not be as kind and may end it at 30. But definitely I think you had a good argument to say significant means, you know, if I get beyond 30%, I'm probably beyond significant. I'm in the area that probably should look at capital. That seems to be the rule of thumb for what I'm doing. I don't like rule of thumbs, but that seems to be the answer.
How about like a large water heater? Would that be an
Go
expense?
back to your system again.
Is that part of the plumbing system or is that?
That's part of the plumbing system. That would be considered part of the plumbing system. Unless it, well, it could be part of the heating system, which technically if you're heating with the plumbing system, with the water, that would be still part of the plumbing. But one could argue that could be your heating system too, if that's what you heat with.
And some of those are going to last 10 years, so would they really want you to?
That is a great question. Everybody hear his question? Just yell your question out. That is a great question.
So what about a hot water heater? Expensive hot water heater, you put it in, but it's only have a life expectancy of 10 years. Is there ever a time where you should be capitalizing that?
According to the IRS code, if you fall under a repair versus capital, that 30% rule kind of idea to use, you could use that as a repair if you chose to. But if the IRS said, no, if it's 40% of your cost, or you just want to capitalize it, then you can capitalize it. But you could do it in 10 years if the life expectancy is less than 27.5 years. It's really the minimum of 27.5 years for the life expectancy of that asset. That's the way the code now reads. It didn't read that way before. So that's something that gave some leverage back to us taxpayers to deal with. And the argument is, how long is my roof going to last? I don't know, your rubber roof, it's supposed to be warranted for 25 years. That's up to your 27.5. Some roofs, shingles are warranted for 30 years. They're going to look at that pretty hard if you try to take that over 15 years and say, I only expect my roof to last 15 years. You might lose that one.
Yeah, you will use that. Good roof will last 30 years.
That's what they'll claim. And the warranty goes along with those things to prove that, or at least the expected warranty, expected life. But if you definitely have something that you know that is more, that is guaranteed, or life expectancy for that particular asset is less than 27.5, you can use that as well as you need. That's why I go back to saying appliances. To me, it makes sense. Appliances don't last 27.5 years. And if they do, you don't want to use it for that long. So typically, you know, I think it makes sense, and I've never had the IRS go against us on things like that when they see something for 5 years that we took as a brand new appliance that was put in to replace another one, as allocating that out, even without doing a proper certified stuff. I just never seen it go back against us on that.
Where does,
We do take them out to lunch sometimes, though, so that helps. Go ahead, Lisa.
where does paint, like paint and
Paint.
flooring, where does that fall under?
Painting would be considered part of the building envelope structure. That's that number 9 down there that they catch everything else with. So if you have to paint every time a tenant moves out, which typically you do, that painting cost is really a maintenance item, not a capitalized item. You didn't better your building by painting the walls. Made it look a little nicer, but you didn't really increase the value a whole lot. So to me, that's definitely repair. You'd want to expense that.
Yeah.
And he also asked about flooring, that would apply to carpets.
I would think the carpeting and flooring and all that would be in that same. Yep.
But what if you're tearing out cheap carpet, putting in expensive ceramic tile?
Aren't you bettering it? Didn't you just do a bettering? Didn't you just do a bettering? Right?
The repair.
Like you reach one of those acronyms on the bar. I mean,
But you're saying tearing out carpet, putting new carpet in.
I think putting in a replacement similar type deal, I think that's what I heard him ask.
Right.
But if you're definitely gonna do a betterment, an adaptation of something else, or even going to the yard, in that case with tile, you could say, well, I'm kind of doing a whole reconstruction of it, I'm really doing a renovation type thing. And then you're improving the value, you've improved the value by one top. I think you're going to be stretched hard. You would lose that argument definitely, and you really have a capitalized item not repaired. For that reason, use that, remember that acronym, that betterment part is really what the IRS looks at hard, or will be looking at hard on that concept. Any other questions? For either my wonderful co-host here, Ron. Thank you, Ron, for all of it. You did too.
We'll be seeing you in
What's that?
We'll be seeing you in
You won't see us anymore.
Well, you see me. You probably won't see me, but
I'm
maybe
talking about the accountants.
you'll see the accountants in April probably. Don't wait that long. Wait, see us in March. Tom.
Yeah, I just have a comment that I think tonight was a good lesson that if a lot of these things are things that you're hearing for the first time, then a lot of these things are probably things that you should be discussing with your CPA annually, because if you're not coming up with these allocations and they weren't done on allocation studies for you, then they're being come up with somehow. And obviously you want to know how that's being done and have some input there.
That's a good point. Thank you.
Yeah, what'll happen is that some of the larger firms, is they'll give it to the first year guy out of college to decide how they want to allocate it if you don't tell them. So you want to make sure you have some say in that. And again, it goes back to record keeping, making sure that you keep all the records of, what you did, properties, how much it costs, so that we have those numbers put together. For the next 27.5 years, to some extent, we're not going to have good allocations, until we get past that, because we don't have everything historically. But we can start getting that now, and the sooner we get those numbers, the better off it's going to be for you guys going forward.
Thanks, guys. So, there you have it. I usually think in general terms, and I know enough about this stuff to usually get myself in trouble. And I call these guys who are good at it to come out and fill me out. But, it's good to know enough about this stuff that you can kind of make some choices on your own, but it's always good to have good team members on your side. Next month is on subdivision. And, Tom, do you wanna just share a little bit about that? You having somebody come in, you doing it?
Yep, I sure am. Next month will be Ron Hershey, who's a surveyor engineer with Hershey Surveying. And he's gonna talk generally about surveying, so he'll give us 5 or 10 minutes on how surveys work. I know I'm interested in hearing exactly how meets and bounds legal descriptions are measured and how they actually write those things. And I'm hoping by the time you guys leave that night, you'd be able to look at your deed and actually read through a legal description and kind of plot out your property lines, at least roughly, and know what it means. And then he's going to talk about the subdivision process from start to finish and where it goes from the time you file it and going to township planning commission, township supervisors, and county planning commissions, and why it takes so long and costs so much money.
Thanks, guys.
Do you have time for one story yet?
Absolutely.
Okay. It is a story of two friends, and sometimes we are very slow in calling these people and paying them for advice and that kind of stuff. It is worth it. I have two stories. This happened to two of my friends, and Tom Fanning will know one because he was closely involved with this. I think my friend is that happy, he's going to be okay with me sharing, so it's not like, the one guy called me and he said, last week, he's like, I wanted to do something on my property. I wanted to put a pole barn up and do this and that. He said, I went to the township meeting. It was a total flop. He was totally down and out. He was like, find me another property. He's like, I said, wait a minute. I said, is it that bad? I said, surely there's something we can do. I was one, he tried doing everything by himself. He said, I went in there very ill prepared. I wasn't ready to go. Another guy comes to an auction, buys a property, wanted to put his business there. The next day, I go to another auction, and the township guy's there, and he's like, hey, what's your buddy going to do with that property he bought yesterday? I said, hasn't he been in to see you yet? He's like, no, better not try and put his business there. So I was like, okay, what do I do? I went home, I called my buddy, and I said, here's what you're going to do. Here's the conversation I had. I told him exactly what the conversation was, and I said, don't even go in. I said, call Tom. He called Tom, and he got what he wanted. I don't know exactly what Tom did, but there was some magic that happened. And the bottom line is he put up a very big building, a very nice building, moved his business there. And he told me, we were recently somewhere, and he said, Kerwin, he said, I want to just tell you something. That was the cheapest. He didn't know what he spent, but he said, I think he said something like, that was the cheapest $1,800 I've ever spent in my life, or something like that. So that was, surround yourself with accountants and good attorneys and get their advice, pay them for what they do, and it will be smoother sailing. Thank you very much.